Right. Right.
All right. Hi, everybody. Welcome back. Hope everyone's doing fine. We're here for our latest live market commentary for the month of June, and this is where we talk about the latest developments in the market and share our thoughts about them. I am Albert. I will be your host for today's session, and I'm the Deputy Country Manager here in Malaysia. We're joined by Stephanie, who is our Chief Investment Officer. How are you, Stephanie, today?
I'm good. How about you, Albert?
Doing fine, doing fine. It's been time has passed quite a bit since our last market commentary, where we talked about, I guess, the different things happening in the US. Right, we had the banking crisis. We saw the US government come out and even JP Morgan to come out and bail out the smaller banks. So I guess a lot has really happened since then. And I guess, and I guess as that kind of slowly fades into the rear mirror, I think a lot of the focus in May itself kind of shifted to the debt ceiling in the US. So there were concerns whether the US government would enter a default, given that they could not issue more debt. So I guess there was a lot of drama leading up to then. Last week, we had, after much political drama, we had Biden sign a bill that essentially suspended the US government's debt ceiling at around $31 trillion. So that bill essentially removed the threat of another default crisis all the way until January 1st of 2025. So I guess given this signing of a bill itself, like are there any economic implications from this, given that I'm sure quite a bit of concessions were given to pass this bill?
Yeah, and apologies for my voice because I've been trying to recover from a flu. But anyway, so I think in terms of the debt ceiling, what we've been saying for months is that history suggests that the debt ceiling would get passed, number one. Of course, it makes for very, very good headlines. But I think at the end of the day, the US Treasury is what we call the risk-free asset in globally. And there are a lot of other measures that the government could have taken to cut down expenses before they default on debt. So to us, that was never like a really big concern. It's fun to watch if you're into that sort of thing, like West Wing type of situations. But at the end of the day, to the financial markets, I think the implication is much bigger in the sense that after the bill gets passed, what happens to monetary and fiscal policy. So I think the immediate impact, of course, the longer term impact is the fiscal policy in the sense that the US debt will continue to increase with increased government spending. In the very, very short term, meaning the next few months, however, the passing of the debt ceiling means that the US Treasury can actually start to issue debt again. Because if you look at the debt ceiling that has been reached actually since January this year, meaning that the Treasury was not able to issue any debt for a few months now. Now, when the Treasury can't issue debt to finance its expenses, what they do is that they run down a cash reserve that they keep. So this is called the TGA, and it's a Treasury Generalized Account. Right before the debt ceiling got passed, the Treasury cash account was actually running fairly low. And over the next few months, they'll have to rebuild this pile of cash because you save when you have money coming in and you spend it when you need it. So the implication of this rebuilding means that the Treasury or basically, I mean, the US government will start to drain liquidity from the system, which is, of course, can be mitigated by a few things. But if you compare the liquidity environment over the next few months versus the past few months, is quite different. Over the past few months, actually, we've seen liquidity expansion. And over the next few months, we're going to expect liquidity at least not expanding, if not contracting. So historically, I mean, that has not been a good environment for risky assets. So this is something that I think we should be mindful of, particularly given that we've seen a pretty, I guess, fast increase in share prices of a few stocks. If you look at the S&P this year, it's up around 8 to 10%. However, actually, the majority of that gain comes from only a handful of stocks. Many of them are tech-related and related to AI. So take the poster child, which is NVIDIA. It's now trading at a trailing price to earnings ratio of 200 times and forward ratio of 60 plus times. So these are very, very frothy valuations, and it was largely driven by the liquidity abundance in the first half.
All right, thanks, Steph. I guess also one thing that will really drive liquidity expectations, at least is next week itself, when we have the interest rate decision by the Fed. We also have the CPI coming out next week. I guess, what should we be really looking forward to next?
Yeah, I think so next week it's the Fed's meeting. Now, I would say a week ago, or even just 2 days ago, there was I guess, almost unanimous expectation that the Fed will just stay on hold. Now, the surprise that we got just in the past, I guess, 1 or 2 days is that the Bank of Canada actually increased their interest rates by 25 basis points. And that was actually not expected by the market. It was actually a surprise move. Now, Canada is, of course, the weight of the Canadian Central Bank cannot be compared to the Fed. But given the proximity of these two countries, their economy is actually quite interlinked. And you can actually get some insight from the Canadian data. The reason why they hiked interest rates, actually, they have been on pause for a few months now. So Bank of Canada actually was first to put interest rate on pause in January while the Fed was still hiking. However, the inflation data, recent inflation data in Canada shows that it's been quite sticky, around 4% for core. And even if you look at non-core, it actually picked up in the last, in April. So it slightly picked up from 4.4% to 4.5%. And that got the central bankers quite worried that inflation is going to stay around the 4% persistently. And their target is the same as the Fed's target, is 2%. So they're not seeing the economy slow down quick enough to tame down inflation, which is why they did a surprise hike. Now, given what's happening in Canada, now the market actually puts a 1/3 of a probability to the Fed hiking 25 basis points at their next interest rate meeting, which is next week. Given the Fed's kind of history of not liking to surprise markets, I think it's not very likely that they're going to surprise. But I mean, that tells you that there is some pressure for inflation, for central banks to keep interest rates high, meaning that if you remember, I guess in the last market commentary, we talked about how the market was expecting the Fed to cut interest rates quite quickly in the second half of the year. And back then we said it was actually quite a wishful thinking. But now that given like what's been happening, the market has reversed again. And now actually they expect maybe that the Fed will have to increase interest rates. So all in all, I think until inflation actually falls meaningfully below 4%, we can't say for sure that I guess the economy is really out of the woods in terms of being in a stagflationary period or a stagflationary regime, which is why I guess where where we are currently as measured by ERA. So we'll see what the Fed says, but I guess the key is still what is the inflation data telling us.
All right. I guess that tells you how fluid things can be, given what we just talked about last month, and what we're talking about today, where expectation for rate hikes have, I guess, changed pretty dramatically given what's been happening for other countries, federal central banks. So I guess shifting gears a little bit towards an interesting country, Japan, where we've seen their stock market, well, the topics and the Nikkei itself, they are up about 18% and 25% roughly year to date. And for the topics itself, in fact, it's past its highest peak since the 1990s. So it's been, a pretty long, like 30 plus years, which it has not even gone past its peak. And so this is, I guess, there's been a lot of hype, a lot of excitement surrounding Japan itself, maybe on the back of valuations, on the back of growth kind of picking back up as things reopen there. We have Warren Buffett also kind of supporting Japan through his investments there in trading companies. So my question to you, Stephanie, is now the time to invest in Japan? What makes it so attractive for investors to go in there right now?
Yeah, I think definitely, Japan is generating a lot of buzz. I mean, personally, I love traveling to Japan as well. So, and given how cheap the yen is, I mean, there is a lot of kind of inbound demand, not just for the tourism, but also for the export industry. So historically, I mean, the Japanese yen has been quite important in, I guess, the telling us where the stock market is going. Because if you look at the composition of the Japanese stock market, actually a majority of the companies are exporters. Now, when the Japanese yen gets cheap, now, of course, these exporters actually benefit from the cheaper yen. So if you look at the correlation between yen and the stock market, it has quite a high correlation. I think apart from that, there is also this time around something, I guess, about the inflation regime, which benefits Japan. Because for a long time, Japan has been fighting deflation. And if you look globally among all the developed markets, actually, Japan is one of the few countries where inflation is actually a beneficiary. I guess the government, the central banks, businesses actually could benefit from a bit of inflation rather than deflation. So, and that was also one of the reasons why we have overweighted Japan in our ERA portfolios as well, because in a stagflation environment, Japan stands to be one of the few economies that actually benefit. So, and then lastly, of course, Albert, you mentioned a bit about valuation. Japanese companies are very cheap compared to some of the, I guess, US metrics. So, for example, if you look at some of the biggest kind of conglomerates in Japan, they're trading at around 10 times price to earnings, whereas, of course, the S&P is trading at around 18 times, so quite a lot cheaper. And I guess if you think about diversifying investments away from, I mean, just very concentrated bets in technology or in the US, then Japan would be a pretty good choice. So, I mean, as always, I mean, we advocate having diversified global portfolios, and that's what we do in our ERA portfolios as well. Now, of course, in the very short term, given how much things have gone up, needless to say, the entry point is not as attractive as a few months ago. So just be careful to allocate at this point. A very good way to, if you want to kind of gradually allocate to Japan, a very good way is, of course, to do dollar cost averaging. That applies to shifting your allocations as well. So I would think that could be a good way to get some exposure.
All right, we got a question here, like how can one, I guess, get exposure to Japan through Stashaway's portfolios?
Yeah, so our general investment portfolios all have exposure to Japan. So, I mean, if you invest in one of our GI portfolios, you would have exposure to the stock market there. Secondly, our BlackRock portfolio also has some allocation to Japan. Thirdly, of course, if if you want to kind of create your own allocation to Japan, you can use Flex Portfolio, and we have Japanese stock market ETFs that you can select from.
All right. Okay. We just going to some questions here that people are asking surrounding the US Fed itself. So Stephanie, you talked a little bit about the, I guess, liquidity reduction post this I guess suspension in the debt ceiling. We have a question here, Stephanie. What are your thoughts on money liquidity reduction due to the new supply of Treasury bonds, essentially bonds coming into the market, and its effect on equities and fixed income?
Yeah, so I think if you just think from a very high level, of course, when the Treasury actually issues debt, that drains to refill the cash balance. That basically means that money is stuck at the government and they're not going to spend it. So if money is not spent, then it cannot go into the real economy, so it doesn't benefit the real economy, and that has a contractory effect on economic activities. I guess the question is like how much or to what extent does this affect economic activity? Now here the transmission mechanism and also I guess how much is a bit more nuanced. Frankly, it depends on quite a few moving parts, which I'm not going to kind of delve into here. I guess we're not going to have enough time to kind of dig deeper. But what I would say is, let's say even assume in the best case scenario, compared to what we had in the past few months, which was the Treasury basically using its cash, so injecting liquidity, right now we won't have that injection. And potentially we can have contraction. So typically in these environments, it's not good for risky assets, right? Risky assets, including equities or riskier bonds. So I would advise that take a bit of caution here. But of course, the long-term kind of, if you're a long-term investor, what happens in the next few months actually doesn't matter that much. And those volatilities can actually provide very good entry points for long-term investments. So one way to do it is to do dollar cost averaging so that you can get in when prices kind of are cheaper. The other way is that you can set some maybe, I guess, price, like kind of price limits or just kind of alerts where you would start to kind of like, for example, if stocks are down 5%, that you can start like kind of investing a portion of your spare cash. So these are different ways to take advantage of potential market volatilities.
All right, so yeah, dollar cost average into your portfolios. I guess a follow-up question from the same person who asked the first one. Given the expectation of price cuts going into the year end, I guess more specifically for tech companies itself, which are very interest rate sensitive, what are your thoughts on them?
Yeah, so I think if you look at the correlation of tech stocks versus interest rates, it's been fairly high, meaning that when interest rates come or kind of long-term bond yields come down, tech stocks have rallied. So in a scenario where liquidity gets tighter, that is not great, typically not a great environment for tech stocks, given that a lot of these tech stocks are also quite overvalued. So maybe, again, I use a bit of caution here. Of course, a lot of these are still very, very good long-term holdings. I'm not saying that, like, for example, like we have spoken a lot about artificial intelligence technology. We think that it'll actually improve productivity. It's actually something that could be comparable to the advent of the internet in the 2000s, where it would kind of touch many different industries. But initially, I mean, a lot of times before the earnings actually show, there is like a mini bubble. So I would say if you have some of these stocks, congratulations. Maybe just think about diversifying. If you don't have them right now, there are a lot of like other places that are quite attractive, particularly given that, remember, I mean, cash rates are still above 5%. So for any of your riskier investments to make sense, they have to return more than 5% per year. So just bear that in mind as well as you think about how to position in these tech companies.
I guess follow on from there. Also, we talked about Japan. We got a question here from Ritz. He's asking, given that Stashaway entered into Japan in our previous reoptimization, how has that performed? I guess year to date, from a performance angle.
Specifically for Japan, I mean, the Japanese market is up, I think, close to 20% year to date. And depending on the SRI, because different SRI actually have different allocations to Japan, the contribution will be different. But that's definitely one of the bright spots contributing to our performance in all our SRI portfolios. So if you want to get kind of much more detail, please feel free to reach out to our customer experience team. I'm sure we would be very, very happy to assist.
All right. There doesn't seem to be any additional questions for now, and we're slightly past time. But anyway, thank you to everyone for dialing in today. I hope it has been a helpful, insightful session in regards to about US and Japan. But thank you so much, Stephanie, for your time, and we'll see you all in the next market commentary.
Thank you, Albert, and good night, everyone.
All right, take care.